And welcome to the latest PCD members discussion. Every Wednesday at 2 p.m. we bring you the latest from a variety of sectors of the private wealth sector, featuring showcasing the knowledge of our members in a range of topics that are relevant for advisors to high net worth clients. So great to be joined today by an audience of our members in a Zoom call, and also by a bigger audience live streamed on YouTube. So I hope you enjoy the next 60 minutes and bring you some insight and knowledge around entrepreneurs and exit planning that is useful in your discussions with your clients and with your contacts. We've got an expert panel here today who I'm going to come and speak to shortly. We're going to finish the session for those on Zoom with us in breakout rooms to provide a bit of the networking that we're all sorely missing, and there will be chance for our audience here on Zoom to ask questions of our speakers, which I will try and weave into the conversation or bring back to them direct at the end. So do let us know your questions and comments in the chat. We love to hear from our members and to understand where they're calling from and what they think on this important subject. So just to get straight into the conversation, we've got Stephen Jarvis, who's a partner at Ince, focused on corporate matters and dealing with owner managers among his client base. So good afternoon, Stephen.
Hi, David. How you doing?
Very well, thank you. So just looking really at, I suppose, some of the key trends since last March, since COVID, what have you seen in terms of transaction volumes in your practice? Are deals falling over? We're obviously a long way through the cycle now. What's your perspective as we enter this sort of new normal?
The new normal. Yes, what a great phrase. Well, I suppose it comes as no surprise really to say that, you know, when the pandemic started and we had the first lockdown last year, things went quite quiet, very understandably. Everybody was just unsure as to you know, what the future was going to be. Without dwelling on that too much, I mean, it's quite encouraging to see that, you know, in the latter part of last year, certainly in the private sector, transaction volume really, you know, was increasing. And there were some quite high profile, very large transactions that were in the press. And I think the underlying theme is there is money out there and there are deals to be done. So without trying to sound too optimistic, it's not looking too bad.
So confidence is returning, people are digesting this kind of new environment, and as you say, spotting opportunities.
And it's all about the opportunities, isn't it, with the entrepreneurs? I mean, they have the eye for it.
Yeah, absolutely. So, and I mean, COVID caused everyone to kind of stop in their tracks and look at how their lives are set up, how they operate. And it might have caused some entrepreneurs to think about the sort of short, medium, long-term plan that they have for their business and how that interweaves with their personal plans. I mean, what's your perspective on how those are planning for that short, medium and longer term?
Yeah, it's a good question. I mean, I think there are 3 points or three you know, areas that I've seen here. Firstly, it's been encouraging that entrepreneurs have sort of felt more comfortable coming to their advisors earlier. And I think that's because they, like a lot of us, they just want to know, you know, what does the future hold? So very keen to know what we are seeing in the market. So that's all advisors, you know, on the financial as well as the legal side. Secondly, I think those that are not in an immediate need to sell are, you know, waiting, not rushing. And I've got a, you know, great example of an entrepreneur client at the moment who was involved in the drug and alcohol testing side of business. And then when the COVID pandemic started, he adapted that into COVID tests. And although he's been looking for an exit for about a year now, has kind of put it on hold because he's never been busier. The third point I think to make is that it's a good opportunity for them to get their house in order. So, you know, really sort of making sure there are no skeletons in the cupboard, writing those business plans, and for the entrepreneurs working out, hopefully with their advisors, you know, what are the key points that, you know, that is important to them? What are their objectives in a future sale or exit?
Okay, quite inspiring to see the way entrepreneurs have bounced back, isn't it? As you say, individual clients who've really been in circumstances where they've flip things around and spotted opportunities, I think gives us all cause for hope. But I mean, what are some of the areas that might be overlooked on the legal side in that preparation of what's the thing that the business owner sat opposite you often miscalculates or underestimates?
Well, I think one of the things they underestimate is their own sort of brand, you know, or the image. So, I mean, it's not new, is it, the value of intellectual property, but where there has been a successful business, perhaps with a high profile, or it might be attached to certain names and individuals, I think they forget the value that's there. And so again, it's really important to get specialist advice on that and to make sure that the contracts around intellectual property and certainly development are watertight. So that's definitely an area to look at in the early stages. Again, just really sort of look at those future projections, just know where the value is in the business, where it's going in the future, even if that particular entrepreneur isn't going to be at the steering wheel. And that, of course, comes back to looking at past performance and taking proper financial advice. And the last one, although it's not really legal, and we, every advisor will say this, is tax. Just get proper tax advice as early as possible, both from your tax advisors and your accountants, but also your tax lawyers, because that's where you really can save some money as well going forwards.
And the value of doing all that means that when you enter a negotiation for a transaction, everything's in order and you get the best possible price, isn't it? So it's taking it with a view down the road, because you don't know when an opportunity is going to arise and a decision might need to be made, and then that's not the right time to be necessarily you're chasing your tail a bit. Is that right?
Well, it's 100% right. And of course, when you're in the middle of a sale, the entrepreneur is managing the sale, but they're also managing the business, and they need to continue managing the business. And the last thing they want to be adding to all of that is then having to sort out all the things they should have done beforehand. So it's time well spent to do it now, whether that future sale is in 6 months, 12 months, or even further down the line.
When we were planning for this call, we were chatting about the fact that the entrepreneurial clients you act for don't really often truly retire because they can't resist the next deal. Do you think there's something in the mindset there that makes the opportunities seem too irresistible to actually really step back?
There's something in their blood or the water they drink, but absolutely. And again, I come back to the example of the chap I'm talking to at the moment. He used to own a drug and alcohol testing business years ago. He sold it. He made lots of money. He enjoyed his money, but then he frankly got bored. He went back into it. He learned from all his previous mistakes. He built up a bigger, better business. Then, unfortunately, COVID hit, but he was in a position to get involved in, preparing tests for that. And now he's busier than ever, enjoying himself more than ever, and making even more money. So, yeah, I think it's just part of their DNA, isn't it?
And we're going to come on to talk with Tim Stocks about the variety of sort of ways of making an exit. But the family business being passed on to future generations. Private wealth is not your particular specialism, but I imagine at Ince, a big part of the conversation might be looking at other family members who might want to get involved in the business and things like that. Do you find that family business planning is also interesting?
Oh, very much so. And of course, the different generations have different objectives, don't they? And different lifestyles and views on how things can be done. So yeah, managing all of those expectations, if you like, is part of our role, and it can be quite challenging at times, but usually everyone's working towards the same objective, which is great.
And how important is the team around the client? I suppose in different situations, different professionals might take the lead, but what do you find? Who do you find are the key members of the team in a kind of owner-manager transaction like that?
Everybody has a role to play, and I think the key is in communication and making sure that all of the advisors are sharing their input with each other, as well as with ultimately the client. And all of that, of course, helps the client to achieve their objective, whether that is a complete sale or whether they want a partial sale, etc., to be as painless as possible. So I think, working together, pulling together, and as trusted advisors is the way forward. Thank you.
Terrific. All right. Well, look, thanks for getting us underway, Stephen. Do put your questions in the chat. We'll bring them back to any of the speakers as we go through. But we're just going to bring in Tim Stocks from James Stocks and Co. Good afternoon, Tim.
Afternoon all.
So, Tim, you were a corporate partner at Taylor Wessing for many years. So bring also insight as well as banking expertise to this panel. And based on what we heard from Stephen, what do you think the sort of intrinsic value of getting the legal advice, getting the right legal advice, and how important that can be for owner managers and entrepreneurs as they're approaching these important transactions?
Well, it's vital. It's key that they have a trusted advisor on board who can lead them through a process. It's probably the only time in their life they might sell a business, and therefore they need to get it right. And working with a trusted team, I think, is an important aspect of that. Okay,
so just focusing in then on the merchant banking process and how you might help advise clients. How can you assess the value? You read a lot in the newspaper about pre-revenue technology companies with massive multiple valuations. They're obviously outliers. But how do you go about valuing, a regular company and the process in which you go through to derive that value?
Well, I think there's some interesting stats just to have a look at here. So in terms of where market prices are at the moment, you could say that we were in a bit of a pricing bubble at the moment. But if you look at the S&P 500, it's trading at about 33 times PE, which is quite incredible, 33 years to get your money back. And our expectation in terms of private equity this year is that if you look at buyouts, the typical PE multiples that you might see for, say, 20% of those deals might be 20 times EBITDA or above. And these are quite extraordinary valuations. I don't think we've seen the like of these before in the market. So in terms of timing, now is a good time. We've got the rollout of the vaccine, tick. We have Brexit over and done with, a few issues being wrapped up there as we go along, but tick. And we've got expansionary monetary policies, and money's just being pumped into the global economy from every pipeline available. So there is a lot of money in circulation and a lot of money to find its way into these deals, which are being reflected, I think, in not only the public prices for companies, but also the private prices that private equity and other private equity-backed businesses are prepared to pay at the moment. So in terms of how you get best valuation, well, there's often a time in the cycle when the markets will do it for you.
And I suppose, how much do sort of personal circumstances come into it? Where someone really wants to sell, or there's a perception of weakness. Using the sort of multiples gives you a guide point, but then how much for an individual business do you drill down into the valuation and kind of make an adjustment for the actual circumstances that business operates in?
Well, of course we do, and we would probably approach it in three ways. We would table a kind of football pitch approach in terms of the various valuation parameters, but all tried and tested. Nothing new to throw on the table here. It's been well known to everybody, but we'd probably start off looking at some discounted cash flow calculation of value. We then would probably look at precedent transactions in the sector using databases that we would have access to. And then you look at peer groups, and you're looking at public market peer groups and discounting valuations for a private company as opposed to public. So all quite tried and tested, looking at the debt in the business and adjusting enterprise values down to equity values, etc. And then, as Stephen alluded to, there might be some unique aspects that are not readily noticed in the valuation. That might be intellectual property, but we would argue that the cash flow generated by that RP is taken into account with the discounted cash flow calculations. But there might be other intrinsic assets that don't necessarily pop up in the valuation. Cash on the balance sheet being a good example.
Okay, and I mean, how do you get involved in looking at the appropriate structure? Incentivizing management, negotiating, and all of that. How do you approach that part of the transaction?
So if you start off looking, say, at an owner-managed business, perhaps the owner manager has been running this business for perhaps decades or certainly a number of years. It's probably got a very loyal community around her or him in terms of the business. And the whole sale process does take time, and it does take resource out of the business. So starting point is to be talking to the owner manager. What do they want for the employees? Do they want to give a loyalty bonus, a bonus for the finance director to help through the transaction? Do they want to be seen as the person paying that bonus, because then the goodwill flows from them? In which case, how's that going to be structured? Is it a cash bonus, or what are the tax implications of that? Are there any better ways of doing it from a cash point of view and a tax point of view? So you need to get those things addressed up front, because the owner manager won't be able to do this alone. They will need support, whether it's from the finance department, the legal group, or operational managers on the front line. And that takes time and resource, and people are going to ask the question, what's in it for me? So that needs to be addressed fairly early in the process.
I mean, Stephen, perhaps just to bring you back in, I mean, is looking at the incentives of management teams and obviously the corporate structure is a major part of your advisory piece, balancing off the different interests amongst the parties in a deal. I mean, how do you approach that from the legal view?
Well, yeah, I suppose we start off by asking everyone what they would like to achieve in an ideal world, and then see whether that's possible, both from a legal and sort of tax planning part of view. But I mean, a lot of it also depends on, who's going to stay in the business, whether it's the entrepreneur, the management, or the key employees, and then making sure that people are incentivized. And in these sort of smaller businesses where a lot of focus is around one individual, there is that danger that one individual leaves and everybody else decides they want to go and do their own thing too.
It's a delicate balance. I mean, Tim, just coming back to you, I mean, what is it that if you've got an owner manager who feels like they know their sector inside out, what is it, the broader perspective that you can bring ideas on how they can produce an exit in areas that they might have spent their whole career working and feel like they know every single option? What do you do there to add value?
I think we would add a value around actually who are the buyers for this business, and our general advice is not to have a shotgun approach. So we know that some people would create an investment memorandum and then just go through the telephone directory and send it out, and that's not the way we would work. We say that you need to take the time talking to the owner manager. They will know in their sector who they think would be a likely buyer. And then we need to review those buyers with them. Do they have the cash? Are they in a position to do it? Have they made some strategic decisions that means this is a sector they're moving away from? But then on the other side of that, who are the people who might be wanting to enter the sector? So perhaps private equity backed company with a buy and build strategy. Perhaps your client could be part of that strategy in terms of helping them expand. And the other thing to do, especially with so much money around at the moment, is what we call expand and exit. So people might come to us and say, well, we'd like to sell, we'd like to exit. And we might say, well, hold on a sec. Why don't you take some more money in at the valuations that are available today, might not be that dilutive, and use that money to make some more acquisitions and just beef your business up a bit before you then go and sell, perhaps in a year's time, and put a pipeline together of potential assets that you might want to go and acquire as a way then to really beef up the business and get it into better shape for sale.
Okay, interesting. And what do you see of? We heard at the top about confidence starting to build now. We've got the vaccines in place. There's interest in the UK from abroad for investment. There's money slushing around the system. What do you see in terms of foreign direct investment and kind of interest in UK companies from abroad? Is there any trends there?
No, we see that as very, very strong at the moment. And we would say the market's being driven by inbound deals into the UK at the moment, encouraged by relatively weak sterling, financing available at attractive rates for businesses, certainly a lot of debt finance available. So transactions being done at greater leverage than normal, and therefore a lot of action coming into the UK now. Brexit's done as well. Certainly from the USA, they seem to be quite keen in looking at what assets are available and perhaps being slightly opportunistic as well.
Okay, interesting. I mean, Stephen, are you picking up something similar trends in terms of foreign direct investment and interest from abroad in the UK, in UK companies?
Very much so. I think that without sounding too crude, the money seems to be coming from outside of the UK into the UK. I mean, we have offices, across Europe and the Far East, and again, there's a lot of interest, in the UK business, but particularly from the US, as Tim says.
Okay, perfect. Well, thank you for that, Tim. If there's any questions for Stephen or Tim, put them in the chat and we'll bring them back on. But we're just going to bring in Paul Baker, who's a director at Buzzacott in London. Good afternoon, Paul.
Afternoon, David.
So we were just picking up there with Tim, a lot of interest from the US, foreign investors coming to the UK. Your specialism is around US, UK tax, and you work a lot with entrepreneurs, particularly US citizens who are resident in the UK. But what do you observe in the general trends of interest from US clients in coming to the UK, or and vice versa? It would be interesting to hear your thoughts on the trends there between the two countries.
Yeah, I mean, I think at the start of the pandemic last March, we did see a fall in the number of US citizens coming over to the UK, as there were just so many unknowns at the time. And we did see that some people who had set things in motion, they'd pulled out and deals had fallen as a result of that. And it did pick up again, and then we saw some hesitation again at the back end of last year, and coming over, mainly due to the uncertainty of the potential tax rises on the way. Obviously, the whole world is expecting tax rises in one shape or another in the US, in particular in the US and the UK. We've got to pay for the cost of the COVID measures somehow. But I think, now that people know more what to expect, we've been working remotely for a year, and whilst there are still a lot of unknowns, people, they've got to the point where they can't postpone any further. And we are seeing, similar to what Tim and Stephen said, we're seeing a lot more activity at the moment in terms of US people coming into the UK. Okay,
and do you think that UK people are also similarly interested in the US in terms of, as Tim mentioned, through Brexit, if UK companies are looking to expand, they might be looking overseas, particularly in certain sectors, towards the US. What's your perspective on that?
We do see it in some sectors in particular. So there's cross-border investment both ways. In particular, the tech industry is obviously it's very big in the US, and it continues to be so. We have been helping. I've got a client recently who actually works in the tech industry. He exited from his UK company recently and is looking to set up a business in the US, but whilst remaining resident in the UK. And with that, we've been helping advise on the tax implications of such an arrangement, and the potential for future income and gains, whether that's going to be effectively connected to the US. And then looking at the US-UK tax treaty to determine which jurisdiction will have the primary taxing rights and making sure he's paying the right tax to the right taxman.
Yeah, and important to establish how to extract the profit from an entity that could be hugely valuable. I guess knowing the tax, position coming out at the start must be very valuable to them. But just looking specifically at the tax challenges for entrepreneurs who are US citizens based in the UK, what are the kind of things you might be advising? It's obviously myriad of issues.
I mean, I was going to say that's
things that you might be looking at typically.
I mean that's probably an hour in itself, that topic, to be honest. So I mean, there's several US tax considerations that US individuals are looking to invest in a limited company they need to be aware of. So the first thing that US citizens need to be aware of is basically if US citizens or US shareholders own more than 50% of the total value or voting power of a non-US company, it's known as a controlled foreign corporation for US tax purposes. So in that case, US shareholders are then required to effectively file a set of accounts for the company with their personal US tax return each year. And as it's the US, it has to be done on a calendar year basis. So one of the key pieces of advice we always give it at the start is to make sure you use the calendar year end when you're setting up a UK business.
Well, even a simple UK company, which people think, well, what's more vanilla than that, lands people into compliance issues if they're not.
Compliance and tax. So if back in 2018, the US introduced the global intangible low taxed income rules, known as the GILTI rules. So these are initially seen as tackling the US-based multinational corporations such as the Apples, Amazons of the world, who are shifting their profits out of the US to low or zero tax jurisdictions. And the US basically wanted a slice of the tax pie. So, but the rules do also apply to all controlled foreign corporations. So even the single single owner managed business. And the main impact of that is basically GILTI regulations impose minimum tax on the forward earnings of controlled fund corporations. So US shareholders are required to effectively include on a current basis the aggregate amount of their share of certain income, regardless of whether they take a distribution or not. And without any elections, or if people don't take advice beforehand, then a US individual who has control of a UK company can be subject to punitive tax rates, and it can effectively lead to an 80% worldwide tax rate, which obviously isn't ideal and no one wants.
And many in the sort of private equity industry or other sort of niche parts of financial services come as non-doms, which normally confers a special status, but obviously with the overlay of the US creates huge amount of complexity. So say if you had people looking to apply the non-dom benefits also, how do they approach business structuring? They have to just keep it as simple as possible and make sure they...
I mean, essentially, yes. If they're going to be setting up a UK business, then the non-doms generally have the same tax considerations as just domiciled individuals. The business is going to be in the UK. There's not much they can do in terms of utilising the remittance basis to benefit from that perspective.
And on the personal wealth side, do they use like pensions and things like that? I know these areas can be contentious. I mean, what are the sort of things that they are able to do from a personal wealth if they start to make some money out of these companies? Are there things you talk to them about? Even ISAs can have difficulties, can't they? So
yeah, so I mean, there's a myriad of complexity around the things that US people and non-doms, it's how people can do and can't do. So just looking, you raised pensions and ISAs. The US doesn't recognise UK pensions as qualifying pension plans. So quite often, if they're personally funded, so if you're creating a SIP, then that can create additional compliance requirements in the US. So there's advice around there in terms of how to arrange those payments, in particular with owner-managed businesses, and making sure it comes from the business rather than them individually. And then similarly with ISAs, there's punitive tax rules again with regard to non-US mutual funds or ETFs. So similar to the OIG regime in the UK. They have the US have a similar regime for non-US investments.
So many ways to trip yourself up, but thanks for that, giving us that overview. But I mean, just looking at some of the tax reliefs that are available to UK entrepreneurs, I mean, there's been some changes in entrepreneurs relief. Perhaps you can explain some of that. But what do you see as the most valuable reliefs available for entrepreneurs?
So I think in the past, entrepreneurs have focused on the tax position upon exit. So due to the benefits of the 10% tax rate using entrepreneurs relief. Obviously, as you've just alluded to last March, that changed. So the lifetime gain limit was slashed from 10 million to 1 million. And at the same time, changed the name to business asset disposal relief, or the BAD relief. So business asset disposal relief basically applies where there's a material disposal of business assets on associate disposal. I don't think we've got time to go into all the qualifying conditions, but essentially, if it's a personal trading company, you own 5% of the shares, you've had them for 2 years, you'll get 10%. Just looking forward, obviously, the Office for Tax Simplification put out a report in November, looking at capital gains tax as a whole. And one of the big things that they looked at was business asset disposal relief. And they basically said that if the intention was to stimulate entrepreneurship and investments, then business asset disposal relief is not particularly fit for purpose in its current guise. So they have put some suggestions forward, recommendations. So I think it's to make it more focused on retirement. So I think it's the minimum shareholding of 25%, increasing the holding period to up to 10 years rather than 2, and then introducing an age limit similar to the pensions freedom. So you don't get it until you're 55 or 57 in a couple of years. There are obviously other reliefs as well, which is conscious of time. So there's investors relief, EIS relief. Investors relief isn't something I've seen being used of a lot of. These two reliefs are generally for more passive investors. Investors relief was only introduced a couple of years ago now. and a price, but that does get you down to a 10% rate as well, and the limit is still 10 million on that. So it's certainly something to look at for investors who might not, for entrepreneurs. I think, as Stephen alluded to before, entrepreneurs have one exit and then they're looking for the next project. I know I had an entrepreneur who exited a few years ago who got bored and then just started throwing a lot around in EIS and SEIS investments, just almost for the fun of it, for the excitement.
Yeah, thanks. I mean, Stephen, perhaps to bring you back in, I mean, do you see EIS and SEIS and the tax reliefs that are available on raising investment genuinely interesting to clients, beneficial, something that they find is valuable?
Yes, well, I mean, not surprisingly, anything that might save them some money and help with the planning going forward. I don't think they really care what it's called. Although I love the new acronym of BAD relief. I'm not sure how well thought out that was by the government. But yes, no, I mean, clearly, I think it's really important that we're able to keep up to speed with all of these changes. And again, this comes back to the comment earlier about the team around the client. Whether it's the tax advisors, financial advisors, the legal advisors working together and sharing the information so that we can work out what is best for the client. And obviously, working around what are their objectives, and if they do know that they will be sort of, putting the money back into another project, in the very near future, then obviously these reliefs are really important.
I mean, the prospect of capital gains tax rates harmonising with income tax. I mean, with that, these things don't really cause people to take action, do they? It's more in the background. Is that right? I mean, it's part of the picture. I suppose depends on how far progressed plans are, I would say. I mean, what's your view?
I mean, just on that, we can't, whilst that is in the report and the recommendation to harmonise them, we can't see it. I can't see them, going from 20% to 45%. I can see realistically, potentially somewhere between 25 and 30%. Then the question is, there's so much uncertainty when that's going to come in. We've got history of last year when I think it was 22nd of March, the entrepreneurial relief changed with effect from that date, effectively. And there's anti-forestalling measures as well. So, if there is a capital gains tax rate, you can't, it's difficult advising clients. I have got some clients who are sitting on large gains who are potentially looking at crystallizing some of those now. But it's hard to advise around that in terms of, because we just don't know when they're going to be, and people generally accept if they are going to rise, and we have to pay for the measures somehow.
Sure. I mean, Tim, what's your perspective on tax and the tax environment that we've got with the clients that you deal with?
Well, it's obviously going to be a changing environment, and I think that's an unsettling factor for business owners. I'm not getting a great sense of people saying I've got to sell my business in the next 2 weeks to avoid a hit to capital gains tax. And I think people are, in a wait and see, but I think also realistic to know that with the expansionary monetary policies that have been pursued by government, that there has to be a day of reckoning for all that, which means higher taxation.
Okay, thank you for that. Rob Hodgson, wealth planner from Cazenove, just to bring you in. Good afternoon, Rob.
Good afternoon, David.
So we're just there touching on some of the tax considerations. I mean, from your field in financial planning, what are you looking at with serial entrepreneurs who are looking at the sort of short, medium, and long term position? What are the sort of things you're talking to them about?
That's a great question. I think one of the first things that I find business owners really benefit from is building a cash flow analysis with them. And as you know, the crux of financial planning is really all about having clarity on a client's personal balance sheet, sort of now and then sort of seeing how that may change over the coming years. So if someone's approaching an exit or looking at, say, an initial lump sum and a staged earn out over 2 or 3 years, it's really useful to plot that and then build out conversations from there. And that becomes a great foundation to understand what's important to them, what planning is relevant and when. So we can really bring that exit to life before it's happened. And in an answer to your question around considerations, what we're looking at, the obvious one is estate planning. Obviously, the gentlemen have touched on that earlier, but that's a concern for most business owners. Extracting in some circumstances, tens of millions of pounds from a business that then falls into their estate requires some, serious consideration. And that's obviously where we have much bigger conversations pre-exit as to whether we can divert some shares into trust, or we might be looking at BPR portfolios to sweep some of the gains, depending on when we've been introduced. But also, you'd be shocked how many business owners don't have robust and current wills in place. That should always be the first check when you're looking at IHT planning. But really, the key question also is, what do they need this money to do for them? Is it to provide an income? Is it legacy planning? What's their view on the risk mandate? So whether it's a serial entrepreneur or someone going through their first exit, my main role is to get them thinking about life afterwards, what they want that to look like, and really then we can reverse engineer and start building out a robust plan for them.
So your added value pre-exit are things, mechanical things like you said, like the cash flow, it's the housekeeping, like the wills, but also kicking off that bigger picture conversation. Is that fair to say? Which I imagine takes time to digest. So it's can start early days before before an exit is tabled.
You're absolutely spot on. Yes, and what I often find is entrepreneurs are very good at planning, building, running a company, but often they've given very little thought to what life looks like after an exit. And that's really where, as you say, that's where we add value. And to give you an example, having a few breakfast meetings, dinners with an entrepreneur, sort of 12 months pre-exit, that takes a lot of pressure and urgency out of those conversations. Albeit at the moment, those are chats on Zoom and Teams and Skype and so on. But in all seriousness, in a relaxed manner, I can talk through case studies and offer some best practice and start making some suggestions and really just start educating them around, setting compatible personal and business goals. And on the flip side of that, if we receive an introduction from an accountant or a corporate finance house, after an exit has been completed and the individual's sitting on a very large amount of money, it's really clear to see actually they're often very overwhelmed. And in a previous life, I often had to go to Camelot's head office in Watford to see lottery winners on a Wednesday morning. And the serious note or message there is, you can see some similarities with a business owner who's built a company for 30 plus years and then realized a very large amount of money. They've got these real concerns about security of the cash, the returns on it. People are talking about IHT, they're being asked about philanthropy and should they be investing because cash rates are poor, to put it politely. So again, my main message there really is, actually, it's really important to involve a wealth manager early so we can start working with the business owner, and it's a fluid transition when the exit has been completed. And I think Stephen touched on it earlier. I think a lot of owner managers or entrepreneurs, when they're approaching that sale sort of process, they are run ragged, very, very stressed, going through that due diligence and that sort of final sort of piece. So it's quite difficult to get that attention and really get them thinking about that sort of post-exit planning. But it's very important to do so.
And I suppose that can be for themselves if they're coming to their first exit, or maybe perhaps for the next generation if they're also looking to help their kids kind of understand what this money means. But so how can you help them prepare kind of psychologically then for this change in their lifestyle, or whether it's for them or say or the kids getting ready for that?
Yeah, again, great point. Clients really like hearing about what other people in their situation have done. So if we can provide examples, case studies, offering best practice, that's a great way of preparing someone for an exit. Also, mapping out what the process looks like post-exit. That's quite a good way of sort of just bedding them in and getting them organized, if you will. So for example, just explaining what the account opening process looks like. We take care of the cash management for the first 6 to 9 months. That gives gives them some time to sort of step back, reflect, think about longer term planning. And the key, as we all know, as private client advisors, is to remove the likelihood of any surprises, really make them aware of the options available to them, and guide them through a structured process. And just finally, the team of advisors should be working collaboratively around the client, and that point was made very well earlier, but I completely agree with that. And at Cazenove, we really do welcome that. We're very used to sitting in a meeting with the client, the PA, the accountant, and the legal team, and that's really important, because building what I call the team sheet, it really helps a client get comfortable through that process as well.
Okay, and I mean, on the succession planning side, I mean, perhaps you could give us a sense of some of the things in the toolkit that you talk to an entrepreneur about, whether it's life cover, tax wrappers. What are the sort of things that come through the exit? You've got the cash on the account. Now, hopefully you've started off these conversations well in advance, but what are the kind of things that you might reach to discuss with them on the mechanics of managing that wealth then kind of going forward?
Yeah, so again, coming back to that starting point, legacy planning is very, very important. So at the start of the conversations, typically they're going to have an asset that, typically speaking, is very IHT efficient, and if you are extracting funds out of that, they could or probably most probably will have a serious estate planning issue. So when clients have those significant exits, it becomes clear very quickly that 2 or 3 generations down are still going to have no concerns about finances in the loosest sense. So yes, it's very important. There's a well-known framework, actually, just to talk you through how we explain that to clients. It's known as the 3 L's, and it's quite a nice way of organizing an estate and leading into succession planning. So you've got the 3 L's being liquidity, longevity, and legacy. So liquidity is that sort of 3 to 5 years, what the client needs to live, and make sure they've got that ongoing comfort from a financial perspective. Then you've got the longevity piece, which is that sort of personal balance sheet, the investment engine. That's where we add a lot of value, and that often adds as a bit of a sort of cash buffer into the liquidity piece. And then to come sort of circle back to your point around the legacy, that's around sort of next generation philanthropy, charitable giving, and then it's that tick box of what can we look at. So again, you've mentioned whole of life. Depending on that, we can look at insurance. There's the standard, get the 7-year clock ticking. If we've done some good structured planning before the exit, we might and hopefully have had a trust and diverted some shares into trust. If you need a second bite at the cherry, you can look at some sort of BR qualifying assets as well. So there's a real sort of array really of options that we can look at.
Thank you for that, Rob. A question from Nick Morris from Goldman Sachs. Thank you, Nick, for your question. It's just saying many advisors are aware of the importance of planning ahead of time. It's just how you actually create the urgency. How do you compel people to actually look at this? I mean, Stephen, perhaps you have a perspective on how you encourage those who are busy and doing other things to really knuckle down and focus on this area.
I think all I would tell them is a few war stories. Actually, I mean, I've got a bit of grey hair and I've been around for a while, and I've done a number of exits and MBOs, etc. And I always say to a client in that situation, it's going to be quite shocking having to juggle all of those balls, running the business, and at that time when it's all secret as well, you may have signed an LOI, but the staff don't know. So you've got advisors coming and going in the office. You're trying to keep it quiet. You're trying to run the business. You're trying to deal with all these sort of, planning issues. And it really is a very stressful time. And I have seen, businessmen who have been very confident, very, very sort of able, really struggle to get through it. It's a tremendous, personal stress, and times when it has been too much for some people, and they've literally stepped aside and then appointed somebody else, under a power of attorney to continue with it for them, because they can't, because they're not used to it. They're brilliant at doing what they do and building up a business, but this is all, can be quite new. So, I think I would, without trying to put them off or scare them, I would just tell them a couple of war stories and say, we've got to do this.
So by using your experience, you kind of create the urgency. I mean, Tim, do you have perspective from your long experience working with entrepreneurs in this field?
Well, I think you just sit them down and have a very practical conversation. I mean, do you really want to sell? And if so, do you want to get the best price? And if you want to do all those good things, these are the steps you're going to have to take. if you're half-hearted about it, don't waste your time on mine.
Okay, sure. I mean, Nick, you feel free to pop your mic open. Does that ring true with your experience, or?
Yeah, no, look, everything makes sense. I still struggle. I spend about a third of my time dealing with people who are probably not selling for 2 or 3 years. And actually that's, for my network, those are really valuable introductions. And that's really good advice for my prospects. But a lot of them don't compute the relevance of it to get it out of the way. And you can say, look, this is really important. And I've never heard anyone say they'd wish they'd left it longer to get this stuff sorted out, but sometimes it just goes in one ear out the other. So that's why I asked the question.
No problem. Well, thanks for your perspective there. We are going to go into